All right, all right, all right. We are here. We're in business and we're ready to get started. Market's fleshing a little bit today. For those of you who have a little bit of money in the markets, you're probably feeling it today. It's been flushing for the last few days, and that's just the nature of the beast. But you know what? For those of us who have our hedged positions on, which is for me, it's the Yield Max funds. I have the Yield Max, and some of us have the Granite shares, and some of us have the round heel, round heel houses, round heel funds, then at least we have a little bit of a cushion to help us as the markets turn and fall. Now, this is Boeing. It's kind of indicative. I just happen to have this one up. It's kind of indicative of what the whole market's been doing. So the whole market's been kind of going up and up and up, right? So that's kind of our three drive pattern, three drives, drive one, drive two, drive three. Now we're making a little bit of a pullback in here. We're coming in with a little three drive pattern down, drive one, counter trend, drive two, counter trend, drive three. And that generally brings us back to about half or 50% of the last major move. Brings us back to what I call the Fibonacci sweet spot, which is right down in here. All right. So this is not out of the ordinary. And this is kind of indicative of the entire market. Just happens to be that Boeing's the one that I pulled up here and is indicative of what's going on with the whole market because it's kind of reflective of that. All right. So you're like, well, I should have sold out up here. Well, no, not necessarily. Because if you're in the Yield Max funds, you've got that cushion that keeps coming in. And as the market keeps coming down, you keep adding in additional shares on the way down. You're building what we call a pyramid. All right. So you're drawing your average entry price down. And this is where we want to be right now. As it comes back down into this point here, this is where we really want to be stronger buyers down in these regions here. Buy the dips, right? Buy the areas where the market turns and comes back down. So don't freak out about this. This is not unusual. In fact, I have a model that I have drawn here. And this is the model of the market. And this is generally how we figure the market. That's not the one I want. Here we go. So this is generally how we can figure the market runs. All right. Now I'm teaching a class starting Monday. Today is Friday. Today is Thursday. What is today? Today's Thursday, isn't it? Yeah. I don't want to lose more days than I have. Man alive, I'm running out of days. So this is kind of a model of the way we draw the market. Now, I drew this picture long time ago. I mean, I didn't draw it based on what Boeing's doing today. No, Boeing's doing this, which is a model that we've drawn based on what we call the Richard Wyckoff accumulation distribution model. And this is going to be talked about in my class starting on Monday. So we got Monday, Wednesday, and Friday to talk about technical analysis. And one of the things we're going to be talking about is this model right here. All right. It's called the accumulation distribution model. And what happens is this is being controlled. The markets are manipulated. Surprise! I bet you didn't realize that. The markets are manipulated. All right. The stock market is one great big game. It's like a carnival game. Many of you have heard me say that a number of times. Market is a carnival game. And so the carnival is running the market. All right. And they don't want you to win. That's not the name of the game. That's not how they make money. If you win, they lose. All right. So if you go in and win the big panda, well, they have to give you the big panda, and you're walking around on the fairway with your big panda. And guess who doesn't have a big panda? It's the market, right? It's the guys who are running the whole system behind the scenes. So this is the model that they run the system on. How do I know this? Well, I spent 10 years working back in Chicago at the Chicago Board of Trade in the Education Center. And when I was there, I was teaching people how to use computers, how to teach. I was there teaching the traders how to trade on computers as they were moving off of the floor, those open outcry floors. And so we were teaching those guys how to trade, or actually not how to trade. They knew how to trade. They didn't know how to trade on a computer. So we were teaching them how to trade on a computer. And one of the models that was prevalent back there that those big teachers, I was just a little teacher. All right. The big teachers were teaching these guys the accumulation distribution model. And they would come in and they'd hold seminars, and I'd get to sit in the back of the room and watch these seminars. And then, of course, I'd get up and do my part on how to do it in the computer. So I got to watch for 10 years. I sat back there and watched these guys talk about these accumulation distribution models. And those guys are the ones who run the markets today, right? Those guys that were sitting in me shoulder to shoulder with me in class are now the guys who are running these big Wall Street markets. And they taught them this Richard Wyckoff accumulation distribution model. And it's basically a combination of theories. This is the one theory is the Elliott Wave theory. You're going to want to learn that one. So if you can't make it to class next week, then do a little study on your own. I'm going to teach it. So come to the class and you'll learn about Elliott Wave, you'll learn about Fibonacci, and you'll learn about Richard Wyckoff accumulation distribution. And you'll learn about recurring price patterns and mathematical modeling. All right. Those are the 5 things that we're going to learn about in next class. Count, measure, set up, trigger, and follow through. That's your strategy. And so we need to understand that concept so that we understand what the markets do generally over periods of time. All right. And then this one whole series right here, this box from this side to this side is called a Darvas box. All right. So the market moves through what we call Darvas boxes. So that's the next thing you need to study on your own if you can't make it to class. So we're going to study that stuff here in the labs, and don't worry about it. We'll cover it over time. You can just keep coming back here to the laboratories, and we'll study these accumulation distribution models. All right. But this is what markets have a tendency to do. They go up through what we call an Elliott wave, a 3-drive pattern up. They go through a flat top like this, and then they turn around and they come back down about half or 50% of the last major move of the 3-drive pattern. And that's where they start to go sideways. They go through what we call a reaccumulation stage, and then they start the next rally. All right. So that's just kind of typical. And you can go back in time and you can look, and that's what causes a market to go through larger rallies and smaller rallies. All right. So we have small moves. As we come up through these markets, small moves, that's a small move. It's a big move, but it's a small move overall. And then you have a small pullback, and then you have a rally and a pullback and a rally. Now we're up here in this stage here. You can see it. I mean, it's just as clear as the nose on your face. Look at how this thing just went up exactly right out of the model. So here's this part right here. We went up, we created all these little pullback areas right in here. We went up, we created this little topping formation just like that. And then it comes down just like this. I mean, you couldn't have drawn it any more clearly. So where are we coming into right now? We're coming down out of this piece right here, which is this part right here, aren't we? So we're dropping right here. This big red trend right here is this part right here. And you're like, my hell, and if you can read markets that clearly, why are you not rich, rich, rich beyond your wildest dreams? What do you mean? I am rich, rich, rich beyond my wildest dreams. How do you think I got there? I got there by reading these markets and knowing these things and learning these things from the Chicago Board of Trade when I was back there. There are a bunch of great guys back there who taught me all this stuff 30 years ago, and it just still plays out today just like it did back then. All right. More so even because the guys who were back there learning it when I was back there learning it, they're the ones who are now on Wall Street running the big firms. All right. So that's what we're looking at right now. So we're going through what we call the accumulation stage right now. So we're going to come down in here and we're going to do this sideways dance right in here. This is where the big firms, the hedge funds, and the mutual funds and all those guys, they start accumulating shares all in here because they want to buy low, sell high, right? So they do the buy and accumulation. So they'll go through an accumulation stage. That's what we're seeing here. This will probably dance sideways for a little bit. And of course, they're going to blame everybody. The news is going to blame everybody. And of course, since they're such a biased group of people, they're going to blame the president. They're going to blame the Republicans. They're going to blame everybody gets blamed. But it's not, there's no blame to go around. It's just the nature of the beast. It's just the carnival game. It's how the carnival game works. And then the news, they don't know anything. All they know is what the market did because they don't know any of this stuff. All right. They're just a bunch of guys who graduated in college in news media, right? They're a bunch of news media people. They don't know this stuff. All right. There's a few guys that'll get in there and talk to them about it, but they don't really explain it in a, you ever seen this model pulled up on MSNBC? No. Why? Because they don't know. They don't understand this. They don't get it. All right. So this is the model that we're going to be working off of. And so if that's the case, well, this is where we want to be accumulating as well. So we want to just do what they do. Now, what they do is they buy down here. They go through what we could call the accumulation stage, and then they distribute all the way up. So remember, for every buyer, there's a seller. And if you, as a retail trader, are buying all the way up this trend, which we normally do, right? We like to buy, 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 buy. As the market goes higher, buy, 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 buy. We get up here with a dollar cost averaged position really high way up in here. And this is where our average entry price ends up because we buy all the way up an uptrend. And then what happens is the market doesn't have to fall very far. It just goes that far and we start to lose all our money. And who buys it back? Well, it's the big hedge funds. And then they run it a little bit more. They go here and you start to accumulate some more, and then they drop it one more time. And then down in here, this is where you start to sell out because you're like, oh no, the market's dying. I got to get out of this thing. And that's where they start to buy and accumulate everybody's shares who are selling out. All right, because you're like, oh no, this market's going down forever. I'm never going to be better. Oh, I got to get out, recover. Oh no, and then they're just buying up everything that everybody's scared and selling right in here, and that's what's going on. Because they buy down here, and then what they do is because retail traders are buying up here, well, somebody's got to sell it to them, and it's these big banks and hedge funds. They're selling all the way up that uptrend. That's why I have this indicator down here. And I'm going to turn it on over the top of this one. It's called the CMF, chalk and money flow. And I'm going to get rid of MACD. And you can see that this is telling you this is the tool that the big institutions use. So they come in here and they say this is where the big institutions buy. That's why it's green. Buy here, sell here. Buy here, sell here. Well, what's going on while they're selling? Well, they're selling because you're buying, all right? You're buying. Somebody's got to sell it to you. Well, that's the big institutions. This is the institutions indicator right here. It's called the chalk and money flow, all right? And the reason it's set up the way it is because that's when they buy. They buy here, they buy here, they buy here, they buy here, they buy here. See, they're getting ready to buy right now. They're going to go through a big green stage right here. Big green stage of buying. Why? Because retail traders are selling. They're getting rid of this money. They're getting out. They're like, oh, crap. I lost all my money. I dollar cost averaged all the way up into this circle. And now the market's starting to come down. I better get rid of it. So they get rid of it. And who do they sell it to? They sell it to the big banks and hedge funds who are down here buying the dips, buying low. All right. So they do just the opposite of us because they're the ones who run the carnival game. And they know that that's how we do it. And so they take all our money. And that's why retail traders generally lose money. And it all comes back to this model right here. This is the name of the game right there. And when you understand this game, and I'm going to teach this game in great detail in our class at the university next week, and then, of course, here in the lab. So make sure you come to classes next week. So we're going to apply this to our yield max funds. All right. We can apply this to our yield max funds because we want to be, I'm sorry, hold on a second, losing my voice. All right, I got lots of tea and lemon water and everything ready to go. First thing in the morning. Okay, so here we go. This is the name of the game. So you can go back and take that model that I've just shown you right there, Richard Wyckoff accumulation distribution model, and you can go and look at all your different charts and see that the market moves through those strategies. Now, what I want you to do is remember, the biggest thing I want you to remember is that when we trade by pairs. So if you're going to go in and you're going to trade Tesla, for example, all right, so we're going to go and you're going to buy TSLY, which is the TSLY Tesla fund. And so the Tesla fund is the one that you're going to put your money in. And that's this market right here. You see it dropped pretty good today. So you're going to be looking at your little iPhone. You're, oh, no, I'm losing money. Well, this is the process of accumulation distribution going on in the bigger market. Because remember, this is just a bucket of money that you hold, that you put your money into, and then they trade options over on Tesla itself. So this isn't really what the market, this is not a real market. This is just a bucket of money. Yeah, it's your bucket of money that goes up and down. I mean, it goes up and down with the stock market, just like anything. If the stock market's going down, you're going to lose money. I mean, don't forget, you're trading the stock market. Can you lose money in these markets? Absolutely, you can lose money doing this. just because it's paying big dividends doesn't mean that you can't lose money. You can certainly lose money. It's the stock market. It's the carnival game. You're playing the carnival game. Can you step up to the carnival booth? And we stepped up to the Tesla carnival booth and start throwing basketballs into the hoop, and you miss? Yeah, sometimes you miss, and you don't make. You have to pay an extra ticket so you can keep playing. All right. You're just right now, you're playing an extra ticket. The way I like to put this is that you're the insurance company. All right. And this is your bucket of money to insure the people who are trading the stock market over here. Well, if they get to collect on their insurance policy that you sold them, well, you got to pay out that insurance policy. All right. And if they don't have to collect on the insurance policy, then you get to keep the insurance premiums. But sometimes you're going to have to pay out the policy. When you're in the insurance company, sometimes you have to pay out the policy. All right. Sometimes people actually do crash their cars, and you're going to have to help them buy a new car or fix their car. And that means it's going to come out of your pocket. All right. So that's what we're doing when we are investing in these yield max funds or these granite share funds or these round hill funds. All right. You have to be the insurance company. And so you get to collect all these big premiums along the way. But when the market starts to go down, these guys are buying insurance from you. You're going to have to pay out the insurance policy. It's the nature of the beast. Doesn't mean you don't keep getting your insurance premiums. They have to keep paying their premiums coming in, and they do. But you have to take some of those premiums and give them back and paid for their broken car, pay for their broken stock market is what you're really doing. All right. So if you come in here and you look at TSYY, this is your insurance bucket. Okay. And then we're going to come in here and look at TSL. We're going to look at Tesla itself. Now, Tesla, it's crushing right here, right? So that means that people are losing money. So therefore, they're cashing in. They're cashing in on their insurance policies. And so you have to pay those insurance policies. And that's why your market over here, TSLY, is going down. You're paying out your insurance policies. Look, all this time, you didn't have to pay hardly any insurance premiums. Why? Because the Tesla was going up and they were paying their premiums to you, and you're making all kinds of money, and you are happy. You're like, ha, 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 look at me making all kinds of money. Don't have to pay out no premiums because Tesla's going through the roof, right? But now Tesla's going down. You have to start paying some premiums back. Just the nature of the beast. That's the business you're in. All right. When I told you you're going to have to run this thing like a business, I meant you have to run it like a business. And sometimes you make money, sometimes you lose money in your business. And you go through periods of time when you're going to lose some money. Doesn't mean you bail out of the business. You just pay your premiums and say, well, sorry, you guys are losing money. I guess I'll help you with your premiums. Right. And so that's what happens when you have to give back some of the premiums that you made off these guys through this whole time frame. Now, let's hope that Tesla doesn't keep flushing, because the further it flushes, the more premiums you have to pay out. That kind of sucks. I mean, you still get to keep your premiums coming in. You get those, right? So that softens or dampens the hurt. But nonetheless, they're collecting on their insurance policies, and you're the one that has to pay those insurance claims. So how far do we think this market's going to come? Well, let's look and see at our math model, right? Look at our mathematics. So where did this thing go? Well, it started going up through this thing here, and then it went sideways for a long time through here. It didn't have this strong rally like we would anticipate. This was kind of a tough time for Tesla. They went through a few fundamental issues beyond their technical issues, but they did end up finally going through this stage right here, right? And that's it right there. There's that stage. So this little stage right here was quite not as beautiful as we anticipated. It was a little elongated, but that's okay. I mean, it started off nice, gave us the nice rally, but then on this little pullback, it just kind of stayed in there for a while. And we're like, oh, that kind of sucks. But not really, because we were collecting premiums, right? The whole time people were buying their insurance policies and they weren't collecting on them. So the whole time we're making money and we're happy because we're collecting the premiums on the insurance policies that they were buying, which is the options over on Tesla, right? So they're buying options and we're selling them options and we're collecting the premium and we're making money and we're happy and we're going, okay, this is really a nice business. I like being in the insurance business. And then the market started to take off again. Well, they made a whole bunch of money over there because they weren't collecting on their premium because the market's going up. So we didn't have to pay out anything. So we're really happy and we're making all kinds of money and we're sitting high on the hog and happy as can be. Now suddenly this little model comes along here and this little thing happens here, and now this is what we got ahead of us. So they're going to start collecting on their options premium, and we're going to have to actually lose some money. All right, it's time for us to pay up, pay the piper. How far is it going to come back? Well, it generally comes back to around half or 50% of the last major move before it starts to go sideways again. So we can measure that. So we'll come in here to Tesla. We'll take our little ruler and we'll just go from this very lowest part down in here all the way to the very highest part. And where's half or 50% of that last drive, that last Wyckoff accumulation drive right here? This whole thing is that little piece in Tesla that kind of went a little sideways here, wonky on us. But that's okay. We can still measure it from top to bottom, and we still get our Fibonacci sweet spot right back in here. This is where we think it'll come. Now we're going to probably have a little bit of a jig and a little bit of a jog because that's what it does, right? So it's going to come in here. It'll probably drop a little bit, and then it'll probably bounce. It'll probably go up a little bit, and everybody will get excited, and they'll buy some more, and then it'll drop again, and everybody will get mad. Then they'll start to sell out right down in here, and this is where we'll go through this other little stage where we start the whole process all over. Now, it could come down lower, but generally speaking, this is where it comes down to. So figure we're going to have a little bit of a run through here. That's what the model says. We'll just look at how the model comes out. And so the model says once it comes down off of this peak here, it'll come down, make a little wave, might pop a little bit, but then down in here, it's going to go a little sideways, and then it'll fall again and it'll come down in here. And then we can start to go back up again, right? And that's what'll happen. And so that's how we're going to look at this thing. Now, is it going to be perfect? No, it's not perfect. This wasn't perfect. All right. That's just a guidepost. All right. This is just a guidepost of what it generally does. And you saw Boeing. I mean, Boeing followed it like a train on rails. Couldn't have been any more perfect. Tesla, not exactly perfect because we had this little thing in here happening, but you can still see it. You can still see it occurring, and you can still see the pattern in here. And it's a general pattern. Okay, it's not exact, but that's what's going to happen. We're going to see this market come down in some sort of a general pattern that looks like this. And you just prepare for it. I mean, gird up your loins and be ready for seeing this market down in this region here, because this is where you're going to really start to load up. All right, save up some of your, if you want to save up some of your dividends as they come in and buy down in here in this accumulation stage, you can do that. You don't have to put your dividends in immediately. You can. It'll soften your soften the blow a little bit as the market comes down, but it softens it just by having it in cash too. It's not accumulating any additional dividends though. You're not, that money that's sitting there isn't giving you more money. It's just going to help you get lower prices on your shares. And remember, it's growth plus yield that we're working off of here. And this is yield first, so we're dealing with markets that have bigger yield than growth. Growth is not that great, but the yield is really big, so it's called yield first trading. But if you want to have a little bit better growth, you're dealing with the growth right now. The growth is shrinking, right? I mean, the growth is going down. Even though you're still getting your yield, the yield's coming in. They're still paying their premiums to you. You're an insurance company, and even though they're making some claims, they still have to pay their insurance premiums. So you're getting your yield. So your yield's coming down. So this is some of the bad things about the market. And I mentioned, and somebody mentioned in the comments, how many of you write comments to me? Did you know on YouTube you can write to me and I'll answer your questions? So if you, not only in here, this is the little chat window where we come in here and you guys can write little chat windows. For those of you who are in attendance live, you get to write these little chats, right? And so we can put these in here and wants to be a capitalist bastard. That's what we're doing today. We're going to learn how to be capitalist bastards. Absolutely. All right. And then we're coming in here and we're learning all about this neat stuff, but you can put comments in here live. But you can also in YouTube go in and to the little comment section and write comments and something more than just a little small thing in here. And then I'll go in after class is over and answer your questions. So one of the questions that came in yesterday was, Lan, you were talking about how these things are not all perfect, great, and wonderful. Sometimes there's some downside to these markets. What is that? And that was supposed to be taught last Friday, but we had Ben come in as a substitute teacher. Actually had Ben come in as a guest speaker, and he taught the whole concept of building and accumulating a portfolio. So we kind of missed out on that, and I promised I would do that today in class. So here it is. This is kind of the little I have a hard time with this monitor. So as it comes through, this is the, it's not all how to become independently wealthy using these yield max funds or these high yield funds, yield first trading. And then it's not all ice cream and cake. All right. What are the bumps along the road? Well, one of the bumps along the road is what we just talked about. One of the bumps is that the markets go down sometimes. Oh my gosh. Did you know that? Did you know that the stock market sometimes goes down? It doesn't always go up. Oh my gosh, that's probably a revelation to some people that the market does sometimes go down. And it's not always just going straight up. It's nice when it goes up. We all make a lot more money when it goes up, but sometimes the market does go down. And so we have to, we have to pay those monies back to the people who are making money on the way down. So that's one of the downsides, that you have both growth and you have yield, and your growth sometimes is not growing. It goes down, it shrinks. And so your portfolio will shrink and grow and shrink and grow. But over time, the whole idea is that it'll grow bigger than it shrinks, and it grow, and then it shrinks, and it grows, and then it shrinks, grows, and it shrinks, and grows, and it shrinks. All right, that's the whole idea. Is over time you're going to get this growth and shrinkage, growth, shrink, grow, shrink, grow, shrink. And so that's the whole idea. But you have to sit through those. But we have to kind of manage them the best we can. And then there's some markets that just simply don't grow. I mean, that's the nature of the beast. And if you invest in one of those, well, you're not going to make a lot of money. Okay. And that's what I want to talk about today. So we're going to bring over this little slide here. This is how to become independently wealthy, but it's not all ice cream and cake, right? Sometimes you have some bumps in the road. So I have this little thing here. It says not all candy and roses. What's the fly in the ointment? Yield max ETFs seem to be too good to be true. Well, first of all, you have what we call NAV suppression. NAV suppression is, of course, they don't want the stock to go up, because then you have to pay more for it when you buy the shares. So they can have, I mean, just look at the name of the company. Yield. What's the yield? Yield first investing, right? Yield first investing. Growth, we're taking the growth and we're putting it second. Yield is first. Yield max. Yield max. Maximize the yield. And so by maximizing the yield and giving you the maximum amount of yield they can, sometimes that suppresses the NAV. What's the NAV? It's the net asset value of the stock itself. That's why when you have a NAV suppression, a lot of people complain about that. All right. So they come in and they say, well, why, how come that my TSLY stock never goes up? Well, that's called NAV suppression. They're suppressing the NAV from going up. You don't want the growth because you're getting huge dividends coming in. So they're taking all that growth and they're giving it to you as a dividend. And so I'm not sure if I had a little graphic in here. I wanted to, maybe I could find it would kind of demonstrate that perfectly, but I don't think it's in this slide deck. It's in a different one. Okay, so we got to come back to here, but it's the point is that what you're doing is you're taking your little some of you remember it from class, little gold, your little pots of gold every month, right? You're taking your money out every single month. So what would you rather have? One great big pot of gold at the end of the rainbow, or a little pot of gold every single month along the way? Or now they do it every week. So you're getting little tiny pots of gold every week. Every week you get a little pot of gold. That's suppressing the NAV. Does that make sense? The reason they're suppressing the NAV is because they're giving you the NAV. The net asset value of the stock doesn't go up because they're giving it to you and they're putting it in your pocket so you can go and do something with it. You can go buy a new car. You can go buy food. You can go buy a new house. You can do things with the NAV. They're giving it to you. So that suppresses the NAV. Max income, right? Yield max. If they don't do that, if they didn't give you the yield, well, then the stock would go up, right? The NAV, the net asset value, would increase in value, and then you'd have a big pot of gold at the end of the rainbow. Of course, the problem with that is sometimes the big pot of gold grows, and then at the end of the rainbow, the market flushes, and then you have a little pot of gold. So I always tell people when you trade, and we've done this for 40 years, when you trade, you should take profits along the way. I always say that. Take profits along the way. And so when these guys came out, this Yield Max fund came out and said, hey, we're going to take profits along the way automatically for you, I was like, oh my gosh, this is the greatest thing since sliced bread. Why? Because they're taking profits along the way, but it suppresses the NAV. Is it really NAV suppression? No, it's just moving the NAV from this fund into your pocket. Now, if you want to turn around and put that NAV back in here, well, you're going to keep your NAV in this market, all right? And it's going to grow based on the Tesla market because that's where they're actually doing the trading. So they're actually trading and investing in this market. Now, it goes up and down. Sometimes it goes sideways. It's getting ready to go down right now, and I expect it to come back probably back into these red circles. That's probably where it'll come, and it makes sense, but I mean, that's where it kind of likes to be. Look at this. If we go back all there, it's sat in there for a long time, broke out and went up here. Now it'll probably just come right back down in here again. All right, so it'll sit here and dance along in here a little while. It's going to be painful as the NAV is going to go down because it's going to be suppressed because you're going to have to pay out these premiums to the people who are collecting on the downside, right? Because you sold them some insurance. Now you have to pay the insurance. So that is NAV suppression. All right. This is the NAV that's being suppressed because they're giving it to you along the way. But now you have all this cash that you've accumulated, and now the markets are going to go down. It gives you the opportunity to take all this cash if you haven't put it back in already somewhere else. And what I do is I take it out of Tesla and I'll put it into something else. Now I've got NAV suppression on one of my stocks, and some of you are in the same boat as I am. NAV suppression on Misty. All right. Misty's been going straight down. Look at that thing. Oh my gosh, that's NAV suppression if I ever saw it. But what they do is they keep giving you the premiums back, keep giving you the premiums back, keep giving you the premiums back. And sometimes they give you what we call return of capital. All right. So they give you return of capital, which is ROC. What's capital? Well, capital is the money I gave them. Well, I gave them $100,000. Well, they've given me back most of my $100,000 along with some of the premiums. That's how they give those big premiums. They give you back some of your own capital. And everybody's like really pissed off about that. I'm not pissed off about it. I think it's a pretty great thing. Thank you for giving me my money back. I gave you. They didn't take away my shares. I still have the same number of shares. So it lowers my cost basis. So basically what they're doing when they suppress the NAV and they do a return of capital, not only are they giving you the money that they are making from the premiums, because it's still an insurance policy, right? So you're getting your money from the premiums, but they're also saying, hey, you know what? The NAV keeps going down. So we're going to give you some of your own money back. So that it's kind of like saying you paid too much for your premiums. You paid $25 for your shares here. And now shares are only selling for $8.95. So you know what? We're going to give you some of your own money back, but we're not going to take your shares away. You got to keep the same number of shares. We're just going to give you some of your own money back so that you can lower your cost basis. That's really what it's doing. It's like, oh, we're going to give you a little rebate because you paid too much for your shares. So we're going to do a little ROC, return some of your capital to you. And that, in essence, brings the cost of your value down because you still have the same number of shares. They're just giving you some of your money back so you didn't have to pay as much for them. Right? That's kind of cool. People are like all pissed off about that. And I'm like, I don't know why you're mad about that. That seems like a good idea to me. If the market keeps going down and you keep giving me my own money back so that it shows that I didn't pay as much money for my shares, why am I mad at that? They're just giving you your own money back. Well, thank you very much. And then I have no out-of-pocket risk. And isn't that what we're trying to achieve? We're trying to achieve a no out-of-pocket risk. So if the market keeps going down, well, they keep giving you your own money back and you still get the premiums. Well, that's okay with me. I'm pretty happy about that. I have no out-of-pocket risk. They've just about given me 100% of everything I put in. So now anything they give me is still just cash cow free money. I don't know why people are pissed off about that. All right. So that's one of the ointments, the fly in the ointment is they give you ROC. You can look at it as a negative thing if you want to, but I like to look at it as a positive thing. And then you have limited growth potential. All right. Limited growth potential. What is the limited growth potential? Well, it's not going to go up. If we go look at Tesla again as an example, Tesla's going up good. All right. It's made a nice run. So if we come in here and use our dollar calculator from this low down in here to where it's currently trading, even after this big flush off, that's still a 92% return. That's a lot of money. Tesla went up 92% during that time frame right there. 92%, that's a lot of money. Okay, well, you didn't get any of that. Why? You didn't get any of that because you stayed right here in this market. So you didn't get any of that growth. But you know what? In reality, you did. Why? The reason, again, it goes back to that NAV suppression. The reason you did get it is because it went up like that 92%, but your growth stayed solid sideways, but that's because they kept giving you all this money along the way. As the market went up, you took it out as profit. So take profits along the way, and you kept taking money out and taking money out and taking money out and taking money out. So as the market kept rising, you kept taking profits out. First time you took 17%, then you took 27, then you took 37, then you took 43, then you took 55. Then you didn't take all at once because you said you didn't want to have a big pot of gold at the end of the rainbow. All right, you didn't take a big 90% pot of gold. You took it along the way. So now you got a little tiny pots of gold all along the way. So that's why your NAV is suppressed, and that's why you have limited growth. But it's only limited growth because you didn't put the money back in, or if you did put the money back in, you had the same growth. All right. Maybe not quite as much, but still, nonetheless, you still had some growth. So you have high expense ratios. Now, a high expense ratio is all relative. If somebody's paying you 100% returns every year, and then they say, well, our high expense ratio is 1%, you're like, well, out of 100%, it's okay. I'm not going to complain about that high expense ratio. All right. Because they're making you a lot of money. Well, if they're only making you a 10 or 12% return and they take a 1%, well, yeah, now it's a lot of money. That's 10%, not 1%. That's 10% of what you're making. They're taking as an expense ratio. So it's all relative. It's all a percentage. So people don't take that into consideration. What they do is they say, well, these yield max funds have a 1% ratio, and you can go over and you can trade in this other market, and it only has a 0.2% ratio. So yield max has a high ratio. Yes, but the one that's only giving you a 0.2% ratio only makes you 10% a year. This one makes you 100% a year. So is it a high expense ratio? No, it's actually less, because you're not making nearly as much money over there in that one that has a lower expense ratio, right? So that's one of the big complaints about these markets. Oh, the expense ratio is so high. Not relative. It's all relative. You know, when you look at it from a percentage basis of what those guys over there at a 2%, at a 0.2% ratio are making you versus these guys over here making you 100% on a 1% ratio, it's a lot less money. But they'll tell you it's a high expense ratio. Oh no, but they're not taking into consideration how much money you're making versus the one over there that's making 1/10 of the amount of money. Their expense ratio is actually higher on a percentage basis, but not on a dollar basis, right? So it's statistics, lies, and statistics, right? All right. Lack of historical performance. Now, that is one of the problems that we really do have here. Lack of historical performance. The problem is that these markets, some of them have been going for a while. So Tesla, if we go back and we go to TSLY and we say, I want to look at a weekly chart, you can see this thing started back in 2022 and it's 2025. So we got almost, and that's November. So we got 2 years of history. That's it. And this market been going down. It's had pretty bad NAV suppression the whole time. It started to level off here, but that's because Tesla started to level off. Tesla started to go up, right? Tesla's been going down this whole time, and you're having to pay back insurance premiums. But the premiums that were coming in were still high enough. You're still making money. But you can see we've got very little history. But the history we do have, not very good. But this is the history we're mostly concerned about the last 6 months. How have they been doing? Well, they've been doing really well the last 6 months. Why? Because Tesla's been going up, and we've been taking the profits along the way of Tesla going up. Now, if Tesla starts going down, this is going to start going down again. All right. So this has been the problem that a lot of these funds have been experiencing, and they're still making money. They're just losing a lot of it in the NAV. So people started complaining and saying, we don't like this NAV line going down. We want our NAV line to go up. And Yield Max is like, okay, well, the name of our company is Yield Max. So we're giving you the maximum amount of yield that we can, and that causes NAV suppression. They're like, well, we don't want NAV suppression. That scares us. We don't like markets that go down. So they came in and they said, okay, we're going to do this thing called the Target 12. All right. And one of those, they're just getting them started. So there's only three of the 5 that they're working on. So they still got a couple of them to go. But one of the Target 12s is called SOXY. And so this is SOXY. And so what they did is they stopped depressing the NAV, right? You don't have any NAV depression. Look at this thing. SOXY's going straight up. So why is SOXY going up? Well, the distributions, the yield is much smaller. The yield is, they call it a Target 12 because it's trying to have a 12% return. So the yield is 12%. Well, where does the rest of that money go? Because aren't they famous for having 100%, 80%, 90% yield? Yes, they are. Well, why are they only giving us 12% yield? Well, because they're not suppressing the NAV. They're letting the NAV grow. So they're keeping everything above 12% and they're leaving it in the market, which causes the NAV to go up. Now, if you wanted to get your NAV out, you're going to have to sell your shares. And then what? You stop getting your net, you stop getting your dividends on the shares. Because remember, the dividends, the yield is paid out. The yield is paid out by the number of shares you own, not by how much you paid for them. So that's why you get an ROC and they pay you back some of the cost you paid for the shares on the depressing NAV, that pushes your return back up because now you have less that you invested to get the same number of shares. So ROC is good in that sense that they're giving you your own money back, which means it's bringing down the cost you paid for your shares, but you still have the same number of shares. If you do the target 12, well, they're not going to give you your ROC back because there's no reason. So you're not going to get an ROC, right? And the value of the stock is going up, so it makes you feel happy. Oh, I look at my little iPhone. Oh, look, my stock is going up. I feel happy. But yet your dividends every week, when you get them, it's like, oh, I didn't get a very big dividend. Oh, I'm sad. I got a really small dividend. Oh, every week. It's no fun being in this one. I don't get that big shot of money every month. I got all this money in there. Yes, but your NAV didn't fall. So which do you want? What do you want? What do you want here? Do you want growing NAV? You want a big pot of gold at the end of the rainbow? Or you want little pots of gold all along the way? You have to choose. They're giving you a choice. Now, for me, if I were to critique this company, I would say I want the NAV to go absolutely flat. And they could do it. They could do it. They can manipulate these things. They can pay out exactly what they want. So I think I would like to see this market just go absolutely. They could put that thing on, in this case, $39, $40, and your NAV would never leave $40. It would just be $40 the whole time. And they could sit there and pay out just the amount of money that they make in the shares, so your shares never change price. Every time you want to buy a new share, it'd be $40. And then this would go up and down based on how much money they were making in their premiums, right? So all you'd be making is exactly your premiums. And that would be really cool, I think. For me, I think it's best to see that thing just go absolutely flatline. And then and that would be your max yield. That would be your yield max. So they're not going to give you any ROC, and they're not going to worry about the NAV. All they're going to do is just give you the profits from the share. Now, when you and I trade ourselves, if we go out and trade options and we do this option strategy, something we've done forever, that's what we try to do. That's our goal. We try to have zero growth on the NAV because we're not going to put the money back in. We're going to sit there and just take the profits from the premiums that we get from the options, right? So we're not trying to grow our NAV. Actually, we do. We kind of like to see our NAV go up, but we mostly want to use it to increase the number of shares that we're able, or the number of options we're able to trade, so that we can make more premium ourselves. That's what we're trying to do too. But for these guys, it's all computerized system. I think it would be the best market that you could possibly invest in a yield max fund or a Granite Shares fund or any of these round hill funds would be a market that is absolutely totally flat. Because that means they're giving you the maximum amount of yield. They're not giving you any ROC. They're not giving you your own money back. They don't have to, but they're also not suppressing they're not suppressing the growth. They just give it all to you. So it would be, I guess that would be your NAV suppression, because they're suppressing the NAV because they're giving it all to you along the way. But they're not going to give you more than what they made in the options. So when you come back and you see Tesla, for example, TSLY, and they've been doing a good job of going flat here. So this is why I say this is a great market. I love it. Why? Because this market has gone just absolutely sideways flat for the entire year. And that's what we want. That's what we want. We want no growth, because if we want to buy back into this market, we want these low prices on the shares, so we can get these high dividends and not have to pay a lot for the shares. So when this market just goes absolutely completely sideways like this, that is in my opinion, that is glorious. Okay, glorious, because that means they're giving you everything they possibly can as that market rises in price. Okay, you're getting all your little pots of gold along the way, and they're not growing the NAV. That means they're not keeping any of it. They're giving it all back to you, and you can do with it what you want. You can put it back into this or something else. That's the best thing, in my opinion. All right, so these are some of the complaints about these funds. The next thing is yield max aren't perfect. Surprise! All right, there's things that problems. So that's the NAV suppression. We talked about that. And it's best for investors looking for consistent income, not price appreciation. If you're looking for price appreciation, you don't want to be in these markets, all right, because they don't appreciate. Like I just said, the biggest advantage of one of these yield max funds is that they go sideways. So they don't grow, but they give you all the money they're making. they just give it to you every month. That keeps them flat. So the risk is NAV erosion. Okay, too much future payout may decrease because it's unsustainable. So we talked a little bit about running your business, and so those of you who are in class, you know who Bubba is. So Bubba standing here, and this little guy here invested in Bubba's business. But Bubba, he makes money by pulling dead cows out of. There's a whole story behind it. Do you want to hear the story of Bubba? All right. When I was a kid in high school, my dad came to me, and he said, "Hey, look, Lan," he says, "you're working here at my gas station, making $3.25 an hour, and that I gave you a raise because minimum wage is $3.15 an hour. So you're getting $3.25 an hour. So that's really good for you, making $3.25 an hour. Aren't you happy here working at the little gas station?" I'm like, "Oh, I love it. It's great." All right. And he says, "Well, I've got a better job for you. I was out in the farmer's field the other day, and I saw this guy, and he had a truck, and he had pulled dead cows out of the feed yard." And you know, any of you have ever seen a feed yard, you know how deep the muck is, right? It's like 3 feet deep. The cows are wandering around out there in this muck. Sometimes they fall down and they die. Well, the farmer will pay you $100 if you'll go out and grab that dead cow and pull it out and go throw them away. And so I was like, and my dad was like, "I think that would be a great business for you and me to start together, son. What I'll do is I'll buy a pickup truck, and we'll put a winch on it, and then you can walk out into the muck and hook the winch around the dead cow, and we'll winch that dead cow up. We'll make $100. You'd have to work for like 2 or 3 weeks at the gas station at the rate you're working to make that $100. We could make that in a couple hours, pulling dead cows out of shitholes." I was like, "Dad, I'd rather work at the gas station for $3.50 than walk out into shitholes and pull dead cows out." And so I didn't do the business with him. In hindsight, I wish I would have. That would have been an awesome business, actually. But we didn't do it. And so that's why I'm like, okay, this is Bubba, and he's out there pulling dead cows out of shitholes. And so he needs investors. And so this little guy here, right, that's me, little Lan Turner, investing in Bubba's business so that Bubba can go out and pull dead cows out. Well, if no dead cows are dying, Bubba can't make any money, and he can't give it back to me. So that's the whole idea. If Tesla's not selling enough cars and their stock goes down, well, they can't. You're not going to make money. That's just like any stock, right? So there is a risk of NAV erosion because stocks go down. That's what they do. And so if they're paying out to you all the money that they're making and the NAV's going flat, and then suddenly the market goes down and there's no money to share, well, your NAV is going to go down. Now, you're still going to get your premiums coming in because people still buy their insurance policies, but the NAV is going down because it's being suppressed by the fact that the underlying stock is not rising in price. There's no money to share, no money to give. And that's the nature of the beast. So that's not really much different than any other stock, right? You still have to consider that when you're in the stock market, you're investing in something that could go down, so you could lose your money. I always start every class at the university off, and even these classes, you'll see it comes up with a little, while it's playing that little song, what it's doing, it's telling you, hey, you can lose money doing this. All right, it's our disclaimer. Well, we have one at the end too. So we have a disclaimer at the beginning, and we have one at the end of every video we do and every class we ever do. Where they come up and they say, hey, did you know you can lose money doing this? And then at the end, hey, did you know you can lose money doing this? And then in the middle, we sit there and tell you how you can make money. Right? But we'll always cap it both ends with you can lose money doing this too. All right. It's not all roses and candy. So sometimes markets go down and you lose money and there's no money to share. So you don't get any money. So that's what that little picture is there for. So I want to go through now and start talking about some of the rotten stocks that are out there that have lost money. We have a tendency to sit there and just show you the ones that are making money and the great ones, but there's a bunch out there that are rotten and don't make money. And I've got this list that comes directly from YieldMax. All right, so I'm going to show you this list. You can go get it. It's from YieldMax. Go over to the website, and if I can get it to show up on your screen without doing that silly thing. I don't know why it sits there and grows like that. Microsoft has a little problem with their switching screens. All right, so we're going to blow this up. Now, at the top, you can see this is a list of all the YieldMax funds down the left-hand side. You get your little camera out and take pictures of this if you want to, so you don't have to go find it. You can just get it right here. So grab your little camera, take your photos out, and start taking pictures of this screen. So this is all the YieldMax funds. Now, we've got more we like. We like the Granite shares. We also like the Round Hill. But primarily, these are the the ones that are doing the best, right? They have NVIDIA on the top, and this is an accumulative total return. Now we're going to go look at something a little bit different. We're going to look at yield and growth. This is their cumulative total return since they started their ETFs. All right. And then they give you the inception date. Some are longer, some are shorter, but NVIDIA is at the very top and it's up 311%. They're pretty proud of that one. Misty. Misty is the one that is up 202% and it's been going straight down. All right. So had a lot of NAV suppression, and but it's paying such high dividends that it keeps up with it, right? So we're going to go look at these, and I'm going to show you in Portfolio Matrix. I'm going to show you the chart that shows both the dividends, the growth, and the NAV. So you can see both. You can see where all that money's coming from. This is Palantir, and then Coney, which is Coinbase, which is for those of you who are into crypto. This is like an exchange for crypto. And then Hoy. This is, for many of you have Hoy, which is the little hood. What do they call it? Robinhood. The little Robinhood app. If you have the little Robinhood app, this is that company right there. All right. So they're one of the top, 112% return. They've been growing like crazy because they do crypto, and crypto's been growing like crazy. So they're a crypto exchange, kind of like Coney, kind of along the same lines of Coney. And then, but they, of course, they do stocks as well. So they're actually more. They actually do more than Coney. Coney just does the cryptocurrency, but Hoy does both cryptocurrency and they do the stock market, and they do the futures market. So they kind of do them all. They're becoming a pretty big powerhouse out there. And then you got Netflix. Who doesn't know Netflix, right? Most of you canceled your Netflix subscriptions recently, right? I know a lot of you did. All right, AMDY. This is AMD, chip manufacturer. Snowy, they're just a software company. Amazon. All right, we know Amazon. Google's up 69%. Amazon's up 83%. These are pretty stable companies. So they're not their portfolios aren't nearly as wild and crazy. So wild and crazy again is what makes money in these markets, because they go off of the wild and craziness of the market, which is called the implied volatility, which drives the cost of these insurance premiums up, right? So we got Microsoft, we got Baba, which is Alibaba. How many of you know Alibaba? Alibaba is the Amazon of China. All right. So if you were to take Amazon and put it in China, that's what this company is. It's called Alibaba. Baba. All right. So you got Innovations, Options, Income Strategy. This ARK, OARK. That's Kathy Woods, right? We've talked about her in a class before. And then you got Meta. That's old Mark Zuckerberg out there with Facebook. And then we got a bunch of the, I'm not going to go down and read them all, but you can see Gold Miners, Yield Max. Then we start getting into some of the diversified portfolios where they have more than just a single stock ETF. So single stock ETF is what we've been looking at. And then you see that down here, some of the lower growth ones are the diversified portfolios where they actually have an ETF with more than just one stock in it, and they trade options on all of them, which is a diversification, which is going to lower the overall yield because it's not going to be as volatile, right? It's going to lower the volatility, and so you're going to have less return, but you're also going to have a more stable yield. So that's the diversification one you see down here. Now, the thing I want to show you is down here, some of these are not that great, right? I mean, they've got a whole handful of these that are losing money. And you might not even know that. You're looking at these and you're like, hey, I want to be in mRNA. I want to be in YQQQ. Hey, but wait, it's losing money. Or is it losing money? Maybe some of these are losing money. The problem is this is just showing you the cumulative total return from the beginning. It's not showing you growth, yield, and growth. We have to look at yield and growth. So that's what I want to do here. So I'm gonna actually, you guys probably have your photographs you're taking of the top farm. Let me bring this down a little bit. Go ahead and take your pictures of the lower ones. I'll let you sit that on the screen for a minute. Grab your little cameras and take your pictures. All right. Hopefully everybody's got the picture that they wanted. Not sure if you got the middle ones. You probably I'll just go up to this level here. Take another picture of that one. Just make sure you get all of them. You're taking pictures of the screen. You got your pictures? Everybody got your pictures? All right. So now if you got all those, that's the yield max funds, and that's the numbers that they're returning. There's the whole thing that makes it kind of small. You can't really, you could try and get it all in one picture, but I think that then the text is going to be so small Try and get it all in there. And that's the best I can do. That's the whole thing. I don't know if you guys can take your pictures and still see that whole screen. That's why I blow it up so you can get it. If you want to take a picture of that one, that's going to get the whole thing on one picture, but the text is going to be so small you might not be able to read it in your picture. But I'll leave it there for you to take a picture of anyway, just in case. Maybe you have a better phone than I do. Better camera. All right, so let's go take a look at some of these. We're going to actually go look at them because that number that's on there is not necessarily the truth of the matter. Should I say it that way? Not necessarily the truth of the matter. So we're going to come over here and we're actually going to pull up Portfolio Matrix. All right. And in Portfolio Matrix, the neatest thing that this thing has in the world is this little calculator. And it's right here, this little stock calculator. I'm going to put this on my UBI portfolio so you can see that'll be in the background. But we're going to pull up these funds, and I'm going to show you the little UBI chart. It's the coolest little chart here in Portfolio Matrix. I love this. So we're going to come in. The very first one on the top of the list was NVIDIA, right? So we're going to go NVDY. NVDY, and we're going to pull that up, and you can see what it's been doing over the last year. Now, remember, these numbers here, this was from inception, right? NVIDIA, this is from the cumulative total return from inception. So that's 311% from 511. That's just what it's done on this cumulative return. So we're going to come over and look at how it's just been doing over the last year. And this is over the last year. And you can see it right there. It says 1 year. And so you're going to see your gain right here is a negative 39%. So the gain is the lower number. This is the blue line. Now, combined is what you're really looking for. All right, combined, because you're going to get a negative 39%. So that's your NAV decay, right? Or your suppressed NAV. So what we've generally done is we've come over to this little tool here, right? And we've said, okay, I want to go look at NVDY, and we've always had to do this manually, and we don't really know because all we've got is one number. So we come in here and NVDY, and we come in and we do our little math, and we say, okay, we're going to do $10,000. And those of you who remember this, right? We've done this before, so we'll just do one, just to example it. We take our little calculator, right? A little calculator on our phone, and we go, I want $10,000. I'm going to put $10,000 into NVDY, and it's trading at $15.27. So I'm going to divide it by $15.27. Well, that tells me how many shares I'm going to get. How many shares? 654 shares. And if I have 654 shares, well, I get paid my dividends every week. In this case, I get my dividends every week based on the number of shares I have. So if I have 654 shares, what was the dividend? Well, this little tool right here tells you with this little circle. It says the last time it paid you dividends was 14 cents per dividend. So we say take 654 times 0.14, and on our $10,000 every week, we're going to get $91. We're going to multiply that by 4 because we're going to get them per month. That's $366 per month. All right. And then we'd come in here and say, well, how much is that per year? Times 12. Well, I'm going to get $4,400 on my $10,000. That's a 44% return. All right, a little bit better than 44% return. That would be on 10 months, and we got 12 months. So you got to add a couple extra months in there. So it's going to be better, closer to a 50% annualized return based on those numbers that we just did. A real quick little back of the napkin calculation. Okay, but that's not accurate. Why is it not accurate? Well, it's not accurate because we're only going off of a single number. We're going off the last dividend and the current price. Well, the market wasn't always paying out those rates, and the price wasn't always those rates. So you have to look at the entire model, not just the one last number. The one last number, you look at it and go, oh, that's pretty cool. I'm happy. I'm going to put my money in here. All right. But we have better information now. We have better information. We don't have to do it like that anymore. We're not restricted to just looking it up and doing the manual math. We've come in here and we got this little tool called Portfolio Matrix that does this math for us, and it's more accurate because it goes back one entire year and looks from where in the top of the price, takes all the price into consideration, takes all the yields into consideration, and it tells you what you would have made over the entire year's period of time, not just one little snapshot and then assume that the rest of the year was the same, because it's certainly not. So what we had is, in actuality, over the last year, we had a gain of negative 39%. So that's the NAV depression that everybody's talking about. Oh, no, NVIDIA's really went up, but you guys, NVIDIA went down. Well, the reason it went down, and it didn't really go, well, it did here. This part went down. That's when the stock market flushed, right? If you remember, back at the first of the year, the stock market really went down hard. But then it turned around and recovered and came all the way back up. So taking that all into consideration, the gain was negative 39. All right. It went from this location up here to where it is down here. But that's because we started having such big yield. All right. The yield came in so big, 71% annualized yield. That's unbelievable. Now, just to put that into context, think about Cache Valley Bank. We're going to go down to Cache Valley Bank or Key Bank or Chase Bank or whatever bank you want to call it. And then we're going to go down there and we're going to say, I want to open up a bank CD. I want to put my money in here. And how much interest will you give me? Well, right now it's 3.5%, 4% maybe if you're lucky. All right. Let's just use 5%. Probably double what most people can get on their CDs. We're going to use 5%. Well, how long would it take you to get a 71% return at 5% down at Cache Valley Bank? Well, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70. We'll stop at 70. All right. So that's 10, 11, 12, 13. That's 14 years to get a 71% return at Cache Valley Bank. 14 years. And that's at a 5% return, not the 3.5 or 2.5 that you're going to get. That's crazy money. To put that 71% return into context, that's what you have to do. That's unbelievable. Let's also talk about the S&P 500, which averages 12%. Let's say you put your money into the S&P 500, 12. Let's just go back down to 10 just to make it easy counting. 10, 20, 30, 40, 50, 60, 70. You're going to have to put your money into the S&P for 7 years to get the same yield return that you got off an NVIDIA on these yield max funds. Why can they do that? Because they're doing an insurance policy model. All right. They're building a company that collects insurance premiums, and that's how much premiums they make. You know what? You ever pay a premium on your truck or on your car, and then you cry every single month you pay it because you didn't collect? No, you don't cry because you cry because you have to pay it, but you don't stop paying it. Why? Because eventually you might crash your car and you're going to want that insurance to cover the cost of the car. But you still pay your premiums every single month. Even if you crash your car, you still pay your premiums every single month. But that's because they give you a little chunk of money back out of all the money you've paid them, right? That's how it works. That's how insurance companies work. Well, that's exactly how these yield max funds work. You give them, they sit there and people are buying insurance premiums, which is the options on their stock. The underlying stock here is NVIDIA. They're buying insurance policies on their stock and they're paying them out to these insurance companies, which are yield max insurance company. Granted, Shares is more of that model of an insurance company, but it's still basically the same concept. All right. So we're going to come through and we're going to receive our premiums every single month from our options. And that's where that money comes from. And that's how they can give you that 71% yield. But this is how many they had to pay out, right? They had to pay 39% out to people who collected on their insurance premiums. So a bunch of people wrecked their car, right? During this first part of the year, lots of people wrecked their cars, right? That's exactly what that's telling you. The first of the year, lots of people collected on their insurance premiums. Okay. They still paid their premiums, but they collected, and they collected 39% on their insurance premiums. But their yield, we still collected 71% on the insurance coming in. So the insurance company is still profitable by 31%. Again, 31% is a lot of money. It's like 3 times what the S&P 500 made. And you're complaining because you had to have a NAV loss of 39%. But yeah, overall, you got 71% in premiums coming in, and you got 31% overall total. 31% is still 3 times what the S&P 500 did. You can't complain about 300. But now you're saying, hey, wait a second, Land, thing said 311%. Well, that's 300% cumulative over time, and they're not talking about the NAV decay. They're only talking about what they received over the entire life of the thing on this number here. Okay, and that's what that little chart is that they're giving you. So if over the 3 years, that would have been 311% if you added up all of these numbers. So we go back to, we don't have a 3-year in here. When did they start? 23, 24, 20, 2 year. Let's go 2 year. See what this thing says. See if it'll calculate it 2 years. No, it just likes it at 1 year. That's all it's got history for. Oh, no, there it is. It went to switch just as I did it. Yeah. There it is. There's 2 years. They're 149% is what they're saying. This is saying 311%. So this is a cumulative total return. I'm not exactly sure how the numbers are different and why they're different. This is, let's go 5 years. Maybe it's more time. 163. We don't have 5 years of history. We do on the NVIDIA, but we don't on the yield max. There's 2 years. We do. It looks like we have 2 years. But you can see total on that was 145. This is minus 28 for 116. Still not the 311 that they're reporting. So I'm not sure the difference. Don't know the difference. Don't know why it is, but this is the one that's making sense to me right here, is this number right here. So this is the growth of NVIDIA. So that purple line is growth of NVIDIA. This is the Yield Max fund, which dropped by 28%, but 145% over the last 2 years, you've made 116% return. That's in 2 years. That's phenomenal. That's phenomenal. We like to look at 1 year, but that's got 2 years of history. We can look back 2 years. See, just in the last year, because of this one drop, well, it's only 31%. Go to 2 years, 116%. That's an argument for holding these things longer, right? Hang on to them. But that also has to do with the fact that NVIDIA did so well, right? And they didn't collect on their insurance premiums. So if you have a company that collects on a lot of insurance premiums, it outpaces the yield. That's, again, comes back here to the nastiness, right? That comes back here to what we were talking over here about the nasty side, right? It's not all glory, because sometimes they actually collect on their premium. So that's that one. Let's look at another one. Okay, so that was the one that they claim to be their very best. Let's look at the second best, MSTY. Now, this is going to be a fun one to look at, because this is one that's gone straight down over the last 6 months, right? But so the gain has been a negative 55. That's nasty. Look at that big drop. That's really nasty. Now, hopefully you didn't buy it at the very top like that. Ben says he bought his right here at the very top of this peak right here and wrote it, or maybe it was this one. I don't know, but he still made money. But it wasn't, I mean, it was hard because the NAV kept going down. And the NAV keeps going down on this one. See how the NAV's going down? We don't have a lot of history. We don't have a full 2 years. Oh, that's 2 years right there. See, it doesn't go back a full 2 years. So this is 2 years of history. It's had a negative 55. But look at this. The yield is 180% over the last 2 years for 125% return. Again, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70, 75, 80, 85, 90, 95, 100. 110, 100, 105, 110. 100. Look how many years you'd have to have at Cash Valley Bank to make the same thing you made here in 1 year on Misty, or 2 years. This is 2 years. Isn't that crazy money? I mean, it's just unreal money. It's just crazy money. So we come in here, go to 1 year and see what this thing's done over the last year. See, last year we got 109%, but we had 72% NAV decay. That's because Bitcoin, which is Misty, is basically what they do. They invest in Bitcoin. It's a software company, but they just spend all their money on Bitcoin. They buy Bitcoin. And so Bitcoin has been going down. It hasn't been going up. It's gone up over the last 10 years. It's gone up phenomenal, 1,000% or something. But over the last year, just the last year, it's not been doing well. So over the last year, it's gone down 72%. But they paid out 109% in dividends. Right? So that gives you a 36% return. That's still a lot of money, 36% return. What was NVIDIA? NVDY. So 36% on, and this is 31. So Misty, which is actually one of the shitty ones, excuse my language, but it's one of the ones that's been going straight down. Everybody's been complaining, still outperformed NVIDIA, which was one of their very best ones. So if you've been holding on to Misty going, oh, no, I'm losing money hand over fist, I can't believe it, you're still making more money than you are some of their very best funds. That's why it's important to have the right calculator to help you understand what's going on. All right. That's why this little portfolio matrix is pure magic. I mean, this thing is like, it's not even better than sliced bread. It's better than sex. I mean, well, I don't know about that, but it's pretty good. All right. This is a neat little program. And it doesn't only do this for each individual stock. Once you build a portfolio, it'll do this for your entire portfolio. It tells you both the lines for your entire portfolio. Build out in here. It's the coolest thing ever. It's the coolest thing ever. That's why we created it. All right. Okay, well, let's look at another one. Palantir is one that we love, right? PLTY. Now, I took a lot of my dividends. This is how I did it. I took a lot of my dividends out of Misty, and I put them into Palantir. So most of the money that, I would say all of the money I have in Palantir actually came from my yield in Misty. I didn't take keep taking the money in Misty and putting it back in. I kept putting it over here in Palantir. And this is how my portfolio grew so big. So you can see the gain on Palantir is 0.13, which, remember what I said? 0 would be perfect. And that is the closest thing to 0 that you can get right there, 0.13. I said I would like to see a stock that has absolutely 0 growth on the gain, none. And then it's all coming out in the yield. So look at this. The yield is 87%, 0 growth. They gave you 100% of all the money they made, which was 87%. Holy cow. What was Misty? 32, something like that, 35. What was Nvidia's 32? Palantir was 87. And I caught that. I got that. I didn't get it like right here. I got it like right in here somewhere. I started adding into my Palantir. And then I added more in here. I just kept wanting it to dip a little bit so I could get more. So every time it dipped, I would add in a little down in here. But man alive, look at that. That's what brought my portfolio to the moon, is just one stock right here, because I was taking all the money that I was making out of Misty and some of these other markets, and I was putting them into Palantir. And Palantir had 87% return this year. Now, I didn't catch that whole 87%, but I caught a large piece of it. And how would you know? How would you know Palantir was the one if you didn't have this calculator? You wouldn't know. There's no calculator like this anywhere else. You can't find it in this little program you got on here. You can't. It's not there. This is the only place I know on the entire internet that has this little calculator that runs the markets like this. Because we designed this entire software program around this entire concept. All the other software programs out there have been based on the concepts of the old methods, the old models. These models are brand new, 2 years. It's all this. I mean, that's old. I mean, it's got mold on it in this market. If it's 2 years old, it's got mold on it. That's how new this stuff is. So we've had to recreate this entire model around this functionality just for this market. It's the only one out there. There's nobody else doing this. And this is so new. It's still in beta. So, man, this is neat stuff. Okay, let's go look at the next one. Let's go. We didn't look at Tesla. Let's look at a couple. We've been looking at the good. Well, we keep looking at the good ones. Let's look at Hoy for a second. We got a couple minutes left. All right, so we can look at Hoy. Look at this Hoy. This is your little Robinhood company, right? Little Robinhood company. Look at this thing. Look at this thing. The gain on it's 15%. They had positive net growth, which is rare for a yield max fund, right? So positive growth, and they had a yield of 52% for a 68% return. Holy cow! 68% return. That's unbelievable money. That's so much money. That's like wow money. Wow. All right, let's look at another one. What's another one? Let's look at Amazon. We all know Amazon. Anybody ever bought anything from Amazon? It's AMZY, so it's the fund. So we're going to look at AMZY. Look at Amazon, negative 29%, but that's because of that big drop, and then it went sideways. So I'm not actually sad about Amazon. Amazon is actually pretty good. If we went to a 6-month, we would actually just look at the NAV drop in the last 6 months, not counting that big, huge flush. Remember, because we have that big, huge flush at the first of the year. And so that kind of really throws a lot of this off. These yields are actually bigger than what they are because of that big flush. It's just the return. If you just can't, of course, we had a massive return too. So we had the Trump trade, and you have to just kind of take that into consideration too, that's not real normal market either. I mean, for the market to grow as much as it has in the last 6 months is just phenomenal growth. Right? I mean, whether you like it or not, that's what the tariffs have done for the market. All right. It's just phenomenal growth. Unbelievable. So we're coming in here. The gain on this one here is Amazon was a negative 69. So if we could do a negative 69, right, for what we've got for the last 6 months. So if we could average that, let's say the market just kind of averages negative 7%. That's good. That's good. It's not 0, but it's pretty darn close. And then a yield of 24, which is only for 6 months, but we do the yield for the entire year. Let's go back and see what an entire year. the yield would be. So we can kind of derive this, what we could anticipate, right? So we have a gain of 7 and a yield of 51. So we subtract 7 from 51. It gives you much better than 21. 21 is including this big, huge, massive flush toilet drop. But we still got 21%, which is unbelievable. That's still double the S&P 500, right? But if we were to bring that to 7, which is what we got from this point forward 6 months back, with the yield of 51%, which is still could have been a higher yield, but going forward, we're making a forward projection. We could have maybe 40% on Amazon, which is still really good, right? It's better than what we got on Misty over the last year. But of course, if we did the same thing with Misty, we'd have bigger numbers as well. All right, so then you can see how you can sit there and play with these numbers and kind of do some craziness. So what's another one you guys would like to see? Any of you like to see, throw a name out if you want to see one that you've got your money into. But I want to come down here and I want to look at some of the bad ones. All right. So that's the whole name of this class today. Is it's not all beautiful and wonderful. Let's go look at some of the bad ones. The worst one here, they say, is MRNY. Now, I owned some MRNY and I rolled out of it because it was bad. All right. So I thought that it might settle down and turn around. There was they were getting some good positive news that they were doing some stuff. And then, of course, they got slammed to the mat and pinned. MRNY. Nobody wants to buy their stuff. Nobody wants to buy their Corona shot. So they've been going down. But you know what? If you had MRNY, you had a 71% gain loss. Right? The loss, but they were still collecting premium on there of 76%. You'd still be profitable with a 5% return over the last year. That's still better than you can get at Cash Valley Bank on one of the worst ones. They say it's one of the worst ones. It's actually not one of the worst ones. It's still positive. You're still making money. You're still making money on this one here. Pull it over here one more time. You're still making money on this one. They say it's down 68%. But when you look over the last year, and you take the gains, which is down 71%, and the yield that they collected of 76%, you're still positive 5.34%. Let's go back 2 years. That's a 2-year return. And look, over the last 2 years, they were down 91%. So if you put in $1,000, you've only got $100 left. But on that $10,000, you got 136% return yield. Now, it started out up here, $30 a share, and it's now down here at nothing, $1.60 a share, right? But you still had 45% return, which is still 8 times better than Cash Valley Bank. Crazy money, crazy money. This is not the worst one. It's the worst one on their list, and they're disappointed in this one. But there's worse ones. Let's go look at another worse one. The worst one that I've just quickly, I haven't done all of them, but last night I was looking at some of these. Look at this one. This is YQQQ. This is their short options income strategy. Now, this means that they expect the Qs to go down. So that's why it's bad, because the Qs went straight up, right? So this is really a performance that you wouldn't really, I guess you could be in it if you kept thinking the Qs were going to fall. You'd put your money in here, because you'd make a bunch of money and the Qs being the NASDAQ 100, meaning Apple, Amazon, Netflix, Google, all the tech firms, right? If you thought they were going to flush like toilets and lose all their money, you'd put your money in here. And there's people who believe that, right? They believe we're in a tech bubble, we're in an AI bubble, and it's going to pop and the market's going to flush like a toilet. Could it? Well, it could. I don't think it's going to, personally. And the reason I don't think we're in an AI bubble, and I've mentioned this before, is because most of it, and not all of it, you got a couple of companies who are borrowing beyond their they've got a big debt, and one of them is OpenAI. So ChatGPT is a lot of borrowed money, but a lot of it's been paid for too. I mean, Microsoft has billions and billions and billions and billions and billions and billions of dollars sitting in cash, right? They have big, huge cash reserves. And they're the ones who are buying OpenAI. They're the ones who are funding OpenAI. So although OpenAI might be borrowing money, they're borrowing it from somebody who's got money. They're not borrowing it from a bank, right? So if OpenAI goes out of business, who gets hurt? not you and I. We're not going to be on the hook for it. Microsoft is. And Microsoft's got the money in the bank. So it's cash that's sitting there. They've got the money. This is what's different from the previous tech bubble, right, that we had back there when they called it the internet bubble, an it flush. Well, that's because all of those companies had borrowed money from banks. So it was all real debt. It wasn't coming from big companies that have money like Tesla. Tesla is funding, Elon Musk is funding Grok. And so he's got the money. It's not like he's going to the bank to borrow it. He's got it. So a bubble is when that pops is when they're not making enough money to pay their bills, and they can't pay them, like the United States. Our own economy. We have a $37 trillion debt, right? And we've got to pay those payments every month. And when we can't pay them anymore, well, the bubble's going to pop. Well, that's the same thing that happens. That's what causes a bubble, right? In the market, is that everybody's borrowed money to grow. It's called a margin. And we're on pretty big margin in the markets right now. A lot of people are on margin. I'm not on margin. But if you borrow money to invest, that's kind of troublesome too, if you don't control it. So I think that most of the money that's been pumping into AI has been controlled to some degree. Mark Zuckerberg has billions and billions of dollars, and he's investing it in AI, but he's got billions and billions of dollars in cash, so he can afford it. If he has a bad month or a bad 6 months or a bad quarter, it's not going to put him out of business. And plus, he's got Facebook. This is giving him all kinds of money, and he's doing AI, right? So the AI bubble is being paid for along the way by companies that have money. So if the bubble pops, as they say, who's it going to pop to? It's just going to pop to the guys who've been funding it. So it's not going to pop back to you and I. Now, the stock market might go down a little bit because, why? Why would it? The money's there. They might not be making as much as they're borrowed, but they're able to make their payments easy. They're making so much money in their AI that they're able to make the payments. That's where a bubble pops, is when they no longer can make their payments, right? It's not a problem right now, right? The U.S. economy, we need to grow out of this thing, and that's what Trump's trying to do. He's trying to grow out of this debt problem, because this much debt is a lot of debt if you're this big. But if you can grow and be this big, well, this much debt didn't change, but it's a lot smaller percentage. It's the same thing we talked about earlier, about the fees. This much debt is a lot of debt if you only have this much income. But if you can suddenly be this big, well, this much debt's not nearly as problematic. Same amount of debt, it's just not as near problematic. So that's what Trump's idea is. His economic model is let's grow this country. Let's bring all the jobs back. Let's bring all the factories back. And we're going to grow the country this big. And then that debt is not going to be nearly as problematic for us. But it doesn't happen overnight. You don't bring in all these companies in like 3 days, they all have all their jobs. No, they're building all these big factories. It's going to take years for this to grow out of. All right. So we're going to come in here. Let's look at another bad one. Let's look at one that's a long position, not a short. So we're going to look at A, B, and what? Airbnb. How many of you guys have ever stayed at an Airbnb? Well, here you go. Invest in Airbnb. It's a negative 53%. The yield is 59, so it's only making 5%. So it's making a little bit more than you can make at Cash Valley Bank. So it's still positive. But it's one of their worst. All right. Let's look at another bad one in here. Is DraftKings. Let's look at let's look at their AI options, because it's a bad one. They claim that's pretty bad. AIYY. Excuse me. I'm gonna take this one. And that one, look at that. Down 89% on the gain. But the yield has been 133%. Still 44%. Look at that. That's this one here. AI, where'd it go? AIYY. It's 55 negative. Yield max AI options income strategy. It's the fourth from the bottom. See that? AIYY. Look at that. And it's still making, over the last year, it's made 44% return on your money, even though the yield has gone down 89%. That's nasty. But it gave you 133%. Remember, they pay you on the number of shares you have, not the amount of money you paid for them. And if they just keep doing ROC, which is they just keep giving you your own money back, they keep bringing the price of the share price down that you paid for it, so the yield increases. That's how that works. So if you paid 20, again, it goes back to that same thing we've been talking about. If you paid $20 for something and you get 2% return on it, well, that's a lot less money than if you paid $10 for it and you get 2% return, right? 2% on $10, a lot more money than 2% on $20. So, or 20, other way around. You get the point. 20%, 2% of 20% is a lot more money than 2% of 10%. So when they do the ROC and give you your money back, you're paying less for your shares and you're getting a higher return. That's how that works. So they just keep bringing your share price down by doing ROCC. And that's what they're doing, is they're just saying, oh, you paid $18 for it. Well, we'll give you $2 back. So now you only paid $16 for it. So that means the amount of money you're getting is a higher, it's a lower dollar, but it's a higher percent. Okay. All right. So you got 44% gain plus yield. And that's on their AIYY. That's pretty good, actually, even though it's been going straight down. Let's go look at another one. What's the one you'd recognize? Oh, here's one. ExxonMobil. XOMO. ExxonMobil. So that one is one of their poopy ones. ExxonMobil. They say it's right. That's the first one that made red. 0.77. Yield max XOM options income strategy XOMO. So we'll look at that one. That's this one here. So that's a 2-year. Let's go to 1 year. 1 year is down 29.30. So it's only making 1%. That's not good. Let's go back to 2 year. What was it, 2 year? That's 17% in 2 years. That's not. I mean, it's compared to the rest of these, it's horrible, but it's not bad. But over the last year, it's only made 1%. See, that's had big, but that's because crude oil, the price of crude oil has been going down, right? Trump's been doing everything he can to try and bring energy costs down, and it's been working. And so whatever he's been doing has been working, and so the energy prices have been going down. That's why this market's not making money. I mean, it's making money. It's making a yield of 30%, but you're having to pay out to your insurance premiums, right? 29%. So you're bringing in 30%, but you're paying out 29%. You're just a break even on that one. That's because oil prices keep going down. And that's a good thing. That helps the economy. We want oil prices to come down, right? The whole country runs on diesel fuel. That's what this world runs on, is diesel fuel. If you don't have diesel fuel, we all starve. We all die. Without diesel fuel, we all die. That's just the name of the game. You cut off diesel fuel, you are all dead. We're all dead. So let's look at another one. That's a nice thought to end on, right? Let's come down here. I want to find one we can. Mara. That's, we already looked at Mara. What's Mara? Who's Mara? That's not the one. MARA. Marathon Digital Holdings. I don't know who that is. Does anybody know who Marathon Digital Holdings is? They've got a yield max fund on it. MARO. Is it a target 12? No. All right. So Mara, gain of -71, a yield of 84. It's making 12% return. 12% is still good money, but it's not, 1 year period. It's only 1 year old. It's not even a year old. Whatever Mara is. Let's go look at it just for fun. Let's pull it up. MARO. Oh, it's MARA. MARA. This is the stock. Marathon Patent Group. Why did they think they wanted to trade options on that company? I do not know, but they're flushing like a toilet, aren't they? Man, they're down hard. I do not know why they decided to do that one. They're just pulling them out of their heinies at this point, I think. What else can we put in there? People will buy anything. Let's go. Let's look at a couple that are not on this list. Let's go look at, just for fun. We know that TSYY is one of the Granite Shares versions. We've been looking at all the yield max versions. So TSYY. There we go. So this is TSYY. A lot of people have this one. It's down 71, but that's from this big flush at the IPO. It's up 115% for a 43 over the year. But if let's say you got in 6 months ago, so we'll come down to the 6-month frame. And 6 months, it's only down 44 against 75. But if you could get the same returns that you're getting for the full year against only a 44% drop, trying to cut out that big drop and kind of future project what we might think we would get. So let's even say with a 44% return and we get on a 1-year basis 115. That's pretty good return. That's more like 60%. All right. So this is paying pretty good. TSYY is a Granite shares. Now this one is really truly insurance policy because they sell put options. So they are collecting on when markets go up, these guys collect the premium. Now they also put in a covered put. So if the market falls, they have some protection to the downside, which is something YieldMax does not have. So in a bad bear market, this market's going to do way better than the YieldMax fund. All right. So let's come in here and see. So we got some people. Jay's saying, let's look at SMCY. SMCY, negative 52, yield of 108, and that's a 56% return. So SMCY is that's a chip manufacturer, and they're doing really well, 56%. That's a good one, Jay. That's a really good one. They are having a nasty return here, but it's very volatile. And because it's so volatile, that implied volatility is driving those premiums up over 100%. And so we're getting a nice 56% return. If we go to a 6-month return, that 52 goes down to 46. Not as bad, not as hard on you, but try to reduce some of what, that first year, big massive drop. But it's still going down. There's still. Let's go look at a price chart. SMCI. Super micro. Wow, look at that. So if we do a technical analysis on this, let's just take our Fibonacci ruler. This whole thing's been driven through this narrow channel. It's just been going sideways, up and down, up and down, up and down. It's way down in here. It's down in the buy region. We have to look at some of the fundamentals. Why is super micro having such a hard time? Let's come over here and see. If we go here and pull up SMI. Oh, SM, what was it? SMCY, CY. Oh no, SMC, it's SMCI, super micro. So if we come into super micro, let's come down and see what they're doing. Well, they're making money. Look at the sales. Holy cow. They're not buying their shares back, which is good, but their earnings per share went down. So where are they at right now? 21.97. Their sales are at 21 right now. They're still doing good. I mean, we're in mid-November, so they still have a month and a half left in sales. And they've already matched they haven't quite matched what they made last year. So last year was 21.97, and they're at 21.05 right now. That might be why they were getting a little bit lower earnings per share. This is a good company. See what's going on down here. All the insider traders are selling. They're bailing out of their own company. This is a good company. Sells. Super micro? What do they make? We should do a SWOT on those guys. We could come in here to Grok. Should we do a SWOT on them? I think we like this company. Come on, Grok. I've been having a problem with Grok. He's gotten so popular, he can't keep up with everybody. An SMCI. We're going to put Grok over here in the corner for a minute and let him work on that. We'll come back to it. He's going to work on that for a minute. What's the other one we had in here? We had IFRX. So let's go back over here. IFRX. So Herb Tischer wants to know IFRX. IFRX is not a high yield fund. What is IFRX? IFRX. That's just a normal stock, right? Grok's still working over there, so IFRX isn't coming up. Retrieving data. There it is. InfraRx Nevada. NV. I don't know what this is. This is a penny stock. So that's not got anything to do with Herb Tischer. That's not got anything to do with yield. They've got no yield. Let's go back over here. It's got no yield. It's a penny stock. It doesn't even come up in here. So that one's not going to be much help. Can't do much with that one. Let's go look at it just for fun right here for you. IFRX. So that's they're making money, but the earnings per share aren't good. So that's kind of where their fundamentals are. Making in millions, the 0.18 million. They're a tiny little company. My company was bigger than that. Well, we weren't publicly traded though. This guy's publicly traded and he's a tiny little company. All right, so let's see. Where do we get to? We got our SWOT. Let's go look at our SWOT. SWOT on Supermicro, SMC. So Supermicro Computers is a leading provider of high-performance servers and storage solutions, particularly in AI cloud and data center infrastructure. 2025, the stock closed at approximately $35, reflecting a daily decline of about 6.3% from the previous close of $37.91 and ongoing market volatility and concerns over margins and competition. The SWOT analysis synthesized that. The strengths are it's got leadership in AI and high-performance servers, innovative technologies and vertical integration, strong partnerships in scalable manufacturing, revenue growth, and R&D commitment. What are its weaknesses? Margin pressure and profitability issues. Recent quarters have been seeing gross margins drop significantly to 9.6 in Q2 from 15.5. That's not good. Due to rising material costs and expedited manufacturing and financial performance misses, supply chain operation vulnerabilities. The company faces risk from supply chain disruptions with a 12.4% increase in component costs. Long lead times, 18 to 22 weeks, and geographic concentration of suppliers in Asia. Market dependency and limited brand presence. SMCI derives 87.6% of revenue from enterprise and data center segments, has a smaller global market share, around 3 to 4%, and lower brand recognition. Customer concentration and reporting challenges, high resilience on key customers and past issues with finance. You know what? That's a big deal right there. When all of your money comes from just one or two companies, it's hard for you to even get money. In my business, all of my business when I first got started was coming from like 3 customers. I had 3 big universities who were my customers, and all my business was coming from those 3 customers. And I had like a whole bunch of customers, but Frank, basically all my money came from those 3 universities. And I went to the bank and said, I need a loan. I need to grow. And they said, nope, no money for you. You're too highly concentrated into 3 companies. And if just one of those companies dropped you, you wouldn't be able to pay back your loans. So I couldn't even borrow money because of my customer concentration. And that's a problem. That's one of these things, the weaknesses are saying for this company. Rising operational expenses. 33% year over year. That's not good. Represented a 6.4 net sales challenge, scaling efficiency. Opportunities. They're expanding AI data centers. That's a good opportunity. Demand for energy efficient solutions, geographic and segment expansions, strategic partnership diversification. So basically they say, well, because your geographic is bad, that's also an opportunity to expand on your geographic locations. Threats, intense competition. SMC competes with giants like Dell. So we should go look at Dell and Hewlett Packard. supply chain and geographical risk, microeconomics and regulatory challenges, and rapid technology changes. That is a problem in this industry. Things change so fast. You just go and build out your entire segment, and then the next day they come out with a new something or other, and you're behind again. That was the problem I had when I was mining Bitcoin. And that's such a hard business because I mean, I bought the biggest, best Bitcoin servers in the world, right? I mean, you couldn't get any better Bitcoin servers than I had. And I was mining Bitcoin at $12 a Bitcoin. I was mining Bitcoin and getting them at $12. That's back when you could buy a Bitcoin for $12. I was mining it. And in less than a year, my machines were so slow, they couldn't keep up. I had to replace my machines because, the technology moved so fast that I suddenly got wiped out. I couldn't keep up. I couldn't mine any Bitcoins because I was getting left behind. My profits were going down, 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 down because my computers weren't fast enough anymore. All the new computers could outperform me. I couldn't mine the Bitcoins as fast as everybody else. So that's a problem with the world of technology, right? That's why I went into software. I was like, software doesn't die like hardware. And it's a lot easier. Okay, so that's Grok. So that's IFRX. All right, guys, just to sum it up real fast, that's kind of the name of the game here. These funds are not all glory and wonder. Sometimes they have problems. Return of capital, return of cash and capital. They're best for tax-aware investors who understands ROC implications, reminds you to get your own money back, and that lowers your tax basis. That's good. The risk is future distributions might decrease as NAV and net asset values decline. So as they might give you your money back, but the NAV's going down, a percentage might stay the same, but the percentage again on 10% of $20 is a lot more money than 10% of $10. It's still 10%. You're still getting your high dividend, but as the market goes down and they give you your money back and you have lower basis, that's good, and that's what that helps happen with. But 20% of $50, a lot more money than 20% of $10. So that's part of the NAV decay problem. So it's best for sideways or mildly bullish markets. And we talked about that, right? These markets are really good for mildly sideways markets because they can sell lots of premium because you're not having to pay out on the premium. The risk is investors may underperform the broader market during strong rallies. So if the market takes off and goes to the moon, well, you're not going to participate in a lot of that because all you're doing is collecting the premium from the options on people who are buying insurance. All right. So you're not going to participate in that big run. That's another thing that's negative about these markets. High expense ratios. We talked about high expense ratios. It's all relative. So the high expense ratios aren't necessarily high if it's based on a percentage basis. The dollar amount is high. It looks high, but it could be less actually. So keep that in mind as well. And then your risk factor. Fees can eat into returns, especially if NAV declines. All right. So lack of historical performance. We talked about that. We can only go back on some of these things a year, 6 months. We don't have a lot of historical performance. And that's what, as technical analysts, as market traders and investors, we like to look at a lot of history, see what markets have done in the past, right? So all we can do is kind of derive, like we were trying to do. Oh, we only have 6 months of history, so we'll kind of try and derive what the next 6 months might be. We don't have a lot of history. So it's these funds are best looking for investors who are looking for income because you're going to take your little profits along the way, right? You're not going to get one big pot of gold at the end. There is no pot of gold at the end when you trade in these yield max funds. You're going to get all your little pots of gold along the way. No pot of gold at the end. That's not the way these work. And then there's unknown long-term performance. We don't exactly know, right? We can't do a lot of back testing because there's not a lot of back testing to do because we don't have a lot of history. We can't do back testing. And then, they're best for investors who want high monthly income based off of options income ETFs, those who don't prioritize NAV growth and are comfortable with ROCC, return of both cash and capital. The short to medium term income focused traders who understand options risks and timing when the market is consistently rising but not explosive growth or experiencing extreme downside volatility, just like any market. All right, so they're going to perform just like any market, but they're not going to perform as well as the other market in up markets, but they're going to perform better in down markets. They're still going to lose money. They're just not going to lose money as fast. And that's a nice thing as well, right? We like not losing money as fast, but it doesn't mean you're not going to lose money. You still can lose money. All right, they're not ideal for long-term investors looking for a huge pot of gold at the end of the rainbow. if that's what you want, and you want to, you know, trade into for the next 10 years and look for these high growth funds like Tesla and Palantir and some of these funds that are going to the moon, and you want to jump on those bandwagons and get that big growth and have your big pot of gold at the end of you don't want to trade in these things. That's why I talk about having both, doing a melding of both, right? So you can put some in one to get your income and then some in the other, and you can control that growth. You know, there's a company out there called Seeking Alpha. I don't think we should seek alpha. I think we should design alpha. I think we should build a portfolio where we can design the alpha to be exactly what we want. And that's the whole goal of Portfolio Matrix, being able to put these funds into a portfolio and then decide how much growth we want, how much of the yield and dividends we want, and we build our portfolio and we design our portfolio to give us the alpha that we're looking for. All right, so that's kind of how this thing goes. They're not the magic bullet that you know, sometimes they turn out to be. You know, the people want to make them. They're still playing the carnival game. It's just a different game within the carnival. Go down the fairway of the carnival game. You can throw basketballs, and you can throw ball, you can throw darts, or you can shoot guns. You know, there's all kinds of things you can do in the carnival. This is just one more booth in the carnival game that you can play. It doesn't mean you don't want to play the other carnival games. You certainly can. There's lots of carnival games out there to play within the fairway, right? Lots of tents that you can jump up to and play the carnival game. It's still a carnival game. The stock market is a carnival game. I say it's a carnival game because it's not gambling. It's not like going to Las Vegas, and you're not going to go down there and you're not going to, you know, you're not going to the stock market and gamble like you would in Las Vegas. Las Vegas, the odds are set, and they're set against you every single time. Every time you spin that wheel, every time you flip out a card, those odds are set, all right? And they're against you every single time. But if you go down the fairway of a carnival, you can get good at playing the basketball hoops, even though the basketball hoop is not the same hoop that you play in normal. It's a little bit different, shorter, higher, and further away, but you can still get good at playing that basketball game, all right? You go in and you throw darts, and yes, the balloons have not been fully blown up, and they're kind of half, so when the dart hits it, it doesn't pop. But you can get good at throwing those darts and hitting those balloons. You can still pop a few balloons and win your big panda bear, all right? So the stock market is a carnival game, and it takes strategy and skill to be good at it. But you can do it, all right? And you can put the odds in your favor. Not like the stock, not like gambling in Vegas. You can't put the odds in your favor. You can't do it. It's not designed for that. The stock market is. You can put the odds in your favor and you can beat that. And it can be, you know, what we like to think of as that 1, 2, 3 knockout punch where, you know, if you can get a combination of the great ETFs that are giving a return, you can get some growth and you can build yourself a portfolio, and you can do that through a software program like Portfolio Matrix. You know, you can beat this market. You can have a pretty good life just living off the stock market. Ask me how I know. It's the stock market is my primary source of income at this point. That's where I live off. That's where I make all my money. All right. I have other sources, so I'm not pressured to only make money in the stock market, but the stock market has become my largest income source. And that's where I'm at right now. It's become my 1, 2, 3 knockout punch. And I design my my alpha. I don't just go out and seek alpha. I build my alpha to be what I want it to be. And that's why I'm here. And that's why I'm here helping to teach you guys so you can do the same thing. And that's all I got for you today. We're going to catch up with you. Probably the next lab is going to be next Tuesday. All right. Next time you see me online is going to be next Tuesday. And it'll probably be, we'll probably do a morning session. All right. We're going to start our university class. Is going to be on, starts Monday. And so the lab for that Monday class is going to be Tuesday. And we're going to start looking into technical analysis and looking how to read these charts so that we know how to build our alpha. That's what we want to do. We want to design alpha, all right? We don't want to just go out and seek it. We want to design it. All right, guys. That's all I got for you today. We're going to let you go. And we're going to let you go we got to do a couple of these little things. So if you want to stick around and see, I got to do this one here.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, we'll do one more.
Look, folks, I was reading this thing, Pitt News, right? Great stuff. I mean, back in Scranton, we had newspapers, but I didn't have, you know, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
All right, get Pitt News Magazine. All right, guys, we're going to let you go. We'll see you Monday evening at the university or online Tuesday morning, bright and early at 8 a.m. Have a good holiday, or a good holiday. It's not a holiday, is it? Have a good weekend.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.